Hi there. Welcome to our Pellegrini Financial second quarter market update call here for 2026. And Q2 has been really a continuation of Q1 and positive markets here throughout. And so as we jump right into it, when we look at the equity side of things, we had a few different variations to performance. Obviously, I highlighted there in the top right here that chart of the equity indexes. The Russell 2000 in particular and the Nikkei Japanese market were the strongest performers in Q2. Russell 2000 is really more of the small cap index in the US. And so its performance here through Q2 was quite phenomenal. Actually, really made up the whole year to date number as well. Same with the Nikkei in Japan. It was a very positive market for Japanese equities. On the negative side was the Chinese market. Again, probably influenced a little bit by continuing trade wars, the Iran war, and so on and so forth. And that was negative through Q2 and negative year to date. I just highlighted the TSX and S&P 500 at the top in yellow, just as a reminder where we are year to date. So on the Canadian index, we are up just over 10% here on a year to date basis, and 7.4% on the S&P 500, which is the broad U.S. market. When we look at the sectors in particular, I guess on the Canadian side, energy, of course, and financials were the strong performers on a year to date basis. Energy, obviously, not surprisingly. With Iran war and obviously the jump in oil prices, that's been a positive to energy stocks. In Canada, of course, the financials have been very strong throughout the year as well. And again, based on earnings and just growth in their revenues. And so, as a whole, we've seen markets that have continued to trend upward. April, May, and in June were both positive. June was kind of a tail off as we kind of hit some market roadblocks in July in particular, and that kind of started in June. That said, it's been positive throughout. When we look at more of the fixed income side to begin with, interest rates, the Bank of Canada held steady again here. This is, I think, the sixth meeting now that they've held steady. The U.S. Central Bank, or Federal Reserve, also held steady for the seventh consecutive meeting, as well as I recall. Again, I mentioned maybe a video or two ago now that they were all kind of in a neutral stance, as I refer to it as, and that probably still is the case. And there's still a battle between economic softness or employment softness to inflation concerns, and we'll get into that further in a second. The interesting part of where yields are at or interest rates are at is, of course, as I show the chart on the right here, credit spreads have narrowed considerably, and to the point where you're not paid much for taking on additional risks. So if you look at government bonds or provincial government bonds to investment grade or high yield or to junk bonds, the spread has narrowed and narrowed and narrowed, and that just means you're not paid a lot for additional risk. And so we have seen some of our managers basically, let's call it de-risking a little bit by just gravitating more towards government yielding bonds where you're paid maybe a little bit less, but for a lot less risk. And so we've seen that a little bit in some of our mandates. When we look at some of the broader, longer term, I guess, yield curve in the U.S. in particular, we've seen certainly on the near term rates decrease, but on the longer end increase more dramatically. In the 30 plus years, well over 5% now. And that steepening of the yield curve is essentially a reaction, I guess, to inflation concerns, to the market in general, or to the bond market in general. Now, as a whole, yields have risen, and so that is a good thing for fixed income investors. When we look a bit more at inflation in particular, May's inflation in Canada was just over 3%, although the core had remained around 2%. Inflation had come down in June. It's similar sort of numbers in the U.S., where again inflation was a little higher than expected, although core inflation was still pretty much pegged around their 2.6% or so. Core inflation that hasn't changed as much, and I think that is where the battle is, certainly with the Federal Reserve board down south on, is inflation really a concern when some of the outliers are increasing? Sure, but the core inflation remains the same. I think the concern in Canada is a little less so than what the U.S. is. When we look at some of monetary policies, I know, the Bank of Canada has kind of tightened their quantitative easing in the past already. I know for the U.S. Federal Reserve, Kevin Warsh, the new chairman there, of course, has historically wanted a shrinking balance sheet. That is, of course, yet to happen yet. The European Union, of course, has been doing that already, and so they've, again, from a monetary policy standpoint, have obviously shrunk the balance sheet accordingly. So the charts there just show the inflation in Canada here at the top. The bottom just chart somewhat tied into monetary policy, but just shows level of debt, of course, within all levels of government of Canada. And obviously, it's been trending up for the last, let's call it 15 plus years. Um, Although historically has not been extraordinarily above any historical normals. And so it's obviously concerning to have increasing debt. I don't have a uh, U.S. government debt chart there, but obviously the U.S. government debt has been increasing far more substantially than anywhere else. And at some point, that has to come to an end, and they have to get their banking or their fiscal, I guess, capacity in order. Time will tell whether or not that comes about anytime soon. Maybe midterm elections come November changes that if there's somewhat of a change in their government. Time will tell. When we move on to just employment and GDP, employment numbers as a whole has been somewhat, um, again, continuing to be soft. It's not strong, it's not necessarily weak, and that's the bottom chart there where unemployment rate in Canada is still around 6.6%. Again, not far off historical norms, I suppose. The US numbers, obviously on paper, look a bit better. The one concerning thing, maybe in the US, is that there's a lot fewer and fewer people participating in the workforce. And so you see that participation number, um, or, or, or those that have dropped out, pardon me, of their participation in employment continuing to increase. When we look at GDP, of course, has been a bigger topic here as of late, and that's the top chart. And while it was negative performance, I suppose, through the first half or the tail half of 2025 and the first quarter of 2026. Again, it was pretty nominal in the sense of decline. And as I kind of note in the notes here, two of those three methods of measuring GDP were actually positive in Q1, even though it was a negative number overall. GDP, of course, in this Q2 has been actually quite strong. So they just revised the April numbers up to 0.6% positive. Uh, May came in at 0.3%, and the initial numbers for June looked to be like 0.2% on the positive side. So it's been a very strong Q2 in Canada. The US economically slowed down a little bit more than expected in Q2. Now, it's still very positive numbers, 1.5 to, it's still going to be like 2.1% annualized. And so the growth there has been still robust in that sense. Again, strong consumer spending, and then a lot of capex, obviously, spending in the AI build out in the US in particular, which also is in Canada and, of course, different parts of the globe as well. Moving on from that, looking at commodities and energy. Commodities, again, price of oil has been more obviously up front to all of us here as of late. And so the top chart just looks at the price of WTI. Well, obviously, since the start of the Iran war, the old trend line of $70 to $60, which before the Iran war, oil markets were looked to be as somewhat oversupplied. And obviously, when the Iran war started, you saw a big spike in the price. We've had a lot of volatility in the price of oil based on headlines of the day, of course. And obviously, the mid 80s price now is where we're at currently. That'll obviously change quite dramatically. I think the thing with oil and the longer term trend is understanding what that floor price is longer term. And I again, probably in the background, you're probably looking at $70 to $80 base price of oil now, just based on the fact of lost um, production. Obviously, there's drawdown in inventories, which are now in the U.S. probably down to 1980s levels. Um, and again, infrastructure that has been damaged or not prepared yet, whether that's even Russia or whether that's the Middle East. You have a lot of these geopolitical events that have caused a lot of damage to the oil production and longer term gas supply. That really, I don't think has been priced perhaps in current pricing. But again, uh, I think that's where the floor of where WTI will be longer term. still hasn't been determined, but I'm at a minimum, I think you're at $70 to $80 a barrel now. Natural gas has been weak over the last year or more, and I think at least the go forward position on gas is stronger in the sense, again, there's a lot of energy demand, electrification, both in the obviously North America, but even globally, but North America in particular, to build out this AI capacity needs energy. The issue, of course, is the grid. Can it sustain it? Can you build it out fast enough to what the demand is? But that is still positive for natural gas and electrification in that sense. When we look at commodities and on the gold side of things, precious metals, it's been a basically downward trend for gold here for basically the first 6 months of this year. And, you know, obviously no change to interest rates from the central bank and Federal Reserve is kind of a positive for gold. At the end of the day, it's still kind of facing headwinds from just a stronger dollar and yields that have also increased. So in that sense, it's not as attractive to run to gold when you can be paid on dollars that are fairly secure on interest rates and like I said, yields that have increased. So when we look at kind of going forward, I think the biggest thing is, there's been concern obviously where equity markets are at, and fair to say that they're a little bit overpriced, and that's what this kind of chart here on the left kind of describes a little bit. And the top line looks at trailing PE ratios, and obviously the bottom line looks at the forward earnings. And yes, they're both above their kind of, let's say, 10-year average. Not exorbitantly by any means, but they are certainly trending higher. And I think the takeaway from where markets both have done in the last few years versus going forward as well, that the tech build out, and this isn't just AI itself, but the tech build out in general has always been um, really effective at helping corporations, companies, and industry improve their bottom lines. So again, whether it's technology that helps improve their revenues, reduce their expenses, improve their profitability, whatever it is. And that's where we've seen that when even on earnings calls, you've seen them quite often beat their outlook or expectations, and then the forward guidance is continuing to improve. So while markets have run up quite well over the last couple of years, and we still see elevated equity prices, it has been supported fundamentally underneath by improved earnings. And so that is one good takeaway. Even though they are a little bit overpriced, there's some support underneath. Obviously, there's still concerns of the Iran war and what happens there. And that, again, is nothing else that we can control. It is day by day uncertain as to what goes on there. And hopefully there's a resolution that comes sooner rather than later. Obviously, we've been talking about that now for 5 months now into this thing, and there's not been a resolution yet. That again will play basically into what markets do, and that'll be positive, obviously, when it comes to a resolution to it. The other aspect of that is that the higher yields on fixed income has been positive for portfolios in that sense that the ballast of your portfolio can earn a bit more by sitting in something that's more guaranteed. At the same time, it does create a bit of a headwind for equities as well, because again, it takes a bit of the attraction away from equities when you're paid good to be sitting in bond type of investments. So as a whole, I think I don't expect too much out of this third quarter coming up, in the sense that I think there's a lot of different economic factors that have to be kind of accounted for, whether that's inflation, whether that's economic growth, whether that's employment. Again, there's no significant red flags to say that there's something to be concerned about. At the same time, we've had enough growth over the last year or two that I don't expect too much from equity returns itself. Yet the fixed income has a lot of positives to it. And so as a whole, I think there's enough positive outlooks there that keep markets trending forward and in a positive light. Perhaps a bit more equity fluctuation. We've had that already in the month of July, but again, we've seen some quick rebounds as soon as it kind of hits a floor or bottom. So as a whole, we're quite positive on what things are looking at, and again, quite confident that things will continue on a positive momentum. I'll leave it at that. we do thank you for joining us here in this second quarter call. We look forward to the third quarter coming up in a few months' time. Bye for now.